Today we're going to look at the balance of payments. The definition for balance of payment, it is a record or overall statement of a country's transactions with the rest of the world, normally over a period of a year. So the balance of payments are made up of a couple of components: the current account, the capital account, the financial account, net errors and omissions. This is a balancing item on the balance of payments, and lastly the reserves. So the financial account and the capital account are sometimes seen as the same thing or the same component. It depends on how the country is setting out their balance of payments. Let's start with the first component in my balance of payment, known as the current account. The current account is split up into 4 sections: trade in goods, trade in services, net foreign income, and current transfers or international transfers. Those are the 4 components of the current account. I want to explain the 4 components of the current account in a little bit more detail. So the first concept is trade in goods. It's basically the difference between exports and imports of goods, actual physical goods. So that's why it's also known as trade in visibles, because it's actually, you can touch the goods, it's visible. The second component in my current account, the trade in services, also known as the trade in invisibles, because it's services, it's not physically goods such as the trade in goods where you can touch them, trade in invisibles. So it's the difference between the export and imports of services. A service would be something if you go overseas on a holiday. That would be a service that you are getting from the other country. So it would be an outflow of your country's currency, and the other country would be on the receiving end of the money because you're going on a little holiday there. The third component in my current account is known as the net foreign income section. It is basically profit, dividends, and interests that you are receiving in investments abroad. So if you have any kind of investment in another country's companies, whatever the case might be, you would want to receive some kind of return, and that would be the profits and dividends. So if that would be an inflow into your country's balance of payment if you have such investments and receiving such a return. Then another part of this net foreign income is also income transfers, in terms of, say, if you are working in Italy and you are receiving an income over there, but you're not necessarily an Italian citizen, then that money should come back to your country as a plus on the balance of payment. And vice versa. If you have other country citizens working inside your country, that would be a minus on your balance of payments, because that money needs to go back to the home country of that citizen if they want to take it out. The fourth component in my current account is known as my current transfers or international transfers. These are money transfers between governments who lend to or borrow from each other, and also grants, as well as debit and credit from taxes and excise duties. So now we've looked at the current account, which had its 4 components. So the second major component in my balance of payment is known as my capital account. So the capital account is money or asset transfers. So for example, if you want to immigrate to another country, say you want to immigrate to Australia. That would mean that your assets or your money transfers would be a plus on their balance of payment and a minus on the country that you're leaving's balance of payment. So the third major component in my balance of payment is my financial account. Remember I said previously, sometimes governments or countries don't separate the capital and the financial account. They see it as one component. The financial account has its own components as well. Firstly, we have foreign direct investment. This is money flows to fund takeovers between countries in terms of company transfers and takeovers. Then we have portfolio investments. This is the buying and selling of securities. Then we have other investments, such as the purchases of currency or the making or giving of loans. Then we also have reserve assets. These are gold reserves and currency reserves that a country has. So inflows of money into a country are seen as credits on the balance of payments, pluses. And outflows of money out of a country to another country are seen as minuses or debits on your balance of payment. Okay, so here is an example of a layout of a balance of payment. So I told you before that the net errors and omissions is a balancing item on the balance of payment. So that means that the net errors and omissions need to equate back to the capital, the current account, the financial account, and the changes in my reserve assets. So it needs to equal back to that. So that's why you will see the net errors and omissions would have a balancing amount to that. As well, the whole point of balance of payment, as the word says, balance, it has to balance. If a country's exports are greater than their imports, they are going to sit with what we call a surplus on the balance of payments, or otherwise also referred to as if my inflows, my pluses, are more than my minuses in terms of my balance of payments, I would sit with a surplus on the balance of payments. But the whole idea behind balance of payments, that's why we have the balancing item, the net errors and omissions, is that this balance of payment should balance. Then, the opposite, if my imports are greater than my exports, so my outflows, my minuses, are greater than my pluses on the balance of payments, which happens to a lot of developing countries in terms of their balance of payments, you would be sitting with a deficit on the balance of payments. Deficit on your balance of payment is that it's going to lead to a depreciation of your country's currency, because you probably are importing more than you are exporting, or the value of your imports are greater than the value of your exports, which happens to a lot of developing countries. Whereas a surplus would lead to your country's currency appreciating, which you would say, wow, that would be fantastic. But unfortunately, then your products in terms of the exchange rates would maybe be seen as too expensive, which could curb further exports from your country's side. I want to do a little exercise just to illustrate the flows of money in terms of the pluses and minuses on your balance of payments. Okay, so I will see myself as South Africa, since I am a South African citizen, and I give you the example of a South African citizen is buying chocolates from Italy. Will that be a plus or minus on South Africa's balance of payment? And what will happen on Italy's balance of payment? So it will be a minus or a debit on South Africa's balance of payment. It's an outflow of money. And on Italy's balance of payment, it would be seen as a credit or a plus on theirs. Okay, so I'll give you another example. Again, I'm South Africa. So a foreign company, any foreign company, is using the advertising services of a South African company. How will that work in terms of the pluses and the minuses? Okay, so it will be a plus or a credit in terms of South Africa's balance of payment, because we will be on the receiving end of that payment once the job is done. And it will be a debit or a minus item on the foreign country's or company's balance of payment. Lastly, I just want to quickly chat about deficits and surpluses on the various components of the balance of payments. For example, you are a developing country, so it kind of means that you normally will import more than you are exporting in terms of your goods, or the value of those imports are greater than your export value. So it could mean that you are sitting on a deficit in the current account. But it doesn't necessarily mean that your overall balance of payments would be in the negative or have a deficit. So for example, your financial account has a surplus. So it basically means that the surplus could make up for that deficit, putting you back into balance. So it's not necessarily a bad thing to have a deficit on the one account and a surplus on another or whatever. But the problem lies in if you have a continuous deficit on your overall balance of payments and it doesn't get fixed, because that means your country's currency continues to depreciate, which would mean that it's good possibly for exports, because other countries see your products or your currency as being cheaper, so they get a better bargain. But unfortunately, if this continues, your country kind of is stuck in terms of trade. So you want that little bit of a balance. You don't want that continuous deficit on a balance of payment. Thank you guys for watching. Please go and like this video and also subscribe to the channel. Thank you so much. See you guys later. Bye.